turn sideways, and they go out like spokes in a wheel. And then they send these little explosives down. I've been on drill sites that are about this big. They're like little mini bombs, giant grenades or whatever. And they send them down into the wellbore, and they perforate the pipe and the shale and explode the rock, and that releases the trapped gas. Shales are actually source rock. That's where oil and gas is made, and then it seeps out into what we would call a conventional reservoir. So they're trying to go in. That gives you a good clue of what the industry is up against now. They're finding it so hard to find more and more traditional reservoirs that they're now going into source rock and trying to explode it to get oil and gas out. So this gives you a good indication. In shales, you get about 6.5% of the oil or gas trapped in shales. So all this talk from Terry Engelder, but from Dr. Engelder about we've got this gazillion, trillion feet of gas. Well, who cares if you can only get 6.5% of that gas out of the ground? It means nothing. With conventional reservoirs, you get 75 to 80% of the gas out of the ground. So as you can see, there's a little bit of a problem there for the industry. Also, this is a very interesting statistic. I mean, my mouth dropped open when I saw it. I got the press release from ExxonMobil for their reserve replacements. Now, why is this important? Well, another metric that we were talking about reserves and the growth of reserves. What you want to be able to show, that's one of the primary metrics that, as a financial analyst, you look for in an oil and gas company. I want to be able to see that you're growing reserves. Why? Because you have a depleting asset. And so, if you're not growing these reserves on a yearly basis, then you're just going to go to zero at some point, right? I mean, it's simple math. So they give what they call a reserve replacement ratio. ExxonMobil, one of the largest oil and gas companies in the U.S., just released theirs about a month ago. And a full 40% of the reserve replacement at one of the world's largest oil and gas companies is coming from two shale plays. The Woodford is a done deal. Drilling rigs have gone from 180 drilling rigs down to 2 now in Woodford. Everybody thinks that Woodford is pretty much done, finished. And that's making up a large proportion of one of the world's largest oil and gas companies' reserve replacements. The other is coming from the Bakken. I'm going to go more into detail here about the Bakken in just a moment. But you need to know that based on actual well production in the Bakken, the average Bakken well is in stripper well status, which means you might as well go ahead and plug it and abandon it by year 6. So you've got a very large oil and gas company depending on 2 plays, very heavily on 2 plays, that have extreme depletion curves, and I find that a little bit astonishing. In fact, I thought I'd misread it, and I sent it off to several geologist friends, and they came back with some very interesting expletives when they saw it as well. So, sorry for the I'll let you finish that. So, as I was saying, these majors, these large oil and gas companies, I think they may be in a bit worse shape than you and I think they are, which I find very interesting. They have not been able, we know for a fact they have not been able to materially expand their reserve ratios in over a decade. A full 1/4, and in some years more than that, of their reserve growth has come from acquisitions only, just consolidating other existing assets onto their books. They've been acquiring shale assets because it makes it look as though reserves are growing, even though they really aren't. And they've been engaging in massive share repurchase programs. Now, that's sort of interesting because what they do is another metric that you look at is earnings per share. So you want to take your earnings and you want to divide them into your total number of shares, and that gives you earnings per share, right? So in order to make it look as though you're getting growth in earnings per share, these companies are going in and making massive purchases, buying back their own shares in the stock market, and to the tune of as much as $5 billion a quarter. And what that does is it reduces the number of shares outstanding, which means that your earnings can be divided into a smaller number, which makes it look like your earnings are still on a growth trajectory. But it's really kind of accounting smoke and mirrors in a way. So those are just things that, I mean, everybody knows that. It's not that they're pulling the wool over anybody's eyes, but it's just interesting that they feel the need to engage in this to such an extent. $5 billion a quarter is a lot of money. Okay, so let's look at this. This is energy return on energy invested. and it's written as a ratio, and it's being used in the oil and gas, and it's being used in a lot of industries, but it's used in particular in the oil and gas industry because it's very effective. And basically what this ratio tells you is how many barrels of oil did I have to expend in drilling and operations, trucks and so forth, in order to get X number of barrels out. Well, in the early days of crude, they would expend 1 barrel of crude oil in energy to get 100 barrels of crude oil out. That has now dropped in the U.S. down to 11 to 1, 1 barrel to get 11 out. But in these unconventional hydrocarbons, which you just saw, companies like ExxonMobil are heavily dependent upon now. We're expending 1 barrel of oil to get somewhere between 3 and 5 barrels of oil out. That is what you call not net energy efficient. And so there's a troubling dependence on these low EROEI fuels. Okay, so there's a drilling treadmill. These companies get caught up on this drilling treadmill, and what we mean by that in the financial community is that you get on this treadmill and you can't get off. The only way you can keep shale production flat, all oil and gas production is going to decline over time, but like in conventional plays, you'll typically get a field decline of about 2 to 5% per annum. Okay, in shales, you're getting overall field decline rates of 30 to 50% per annum. That means all the wells in that field, or all the production from that field is going down somewhere between 30 and 50% per annum. So the only way you can keep that production flat is to engage in a frenzy of drilling, which is exactly what you've seen in shales. So based on actual production history, we've done the calculations, and we know that it will cost $42 billion per annum per year, and that number will go up every year. And they will need to drill 7,000 new wells in the U.S. just to keep production flat. They haven't been able to do it thus far. They can't keep up. Remember John Hoffmeister's quote from Shell earlier about these companies are going to have to drill at a capacity that they can't do? That's what he was talking about. And we know that now. They have not been able to do it. In the Marcellus, you'll need 561 new wells per year just to keep production flat. Now, as you move out, they do their geology now. They used to tell us that these were manufacturing models. You could drop a drill bit in anywhere and hit oil and gas and you have this great well. That's not true. They found that in most cases it's about 20% of the wells will make money. And this came from Dr. John Lee, who's considered a legendary petroleum engineer by the industry. He was the architect that the SEC brought in to help them write the rule change. And he, in an email exchange with me, stated, "We hope 20% of the wells will carry the play," and he said, quote unquote, "the other 80% can easily be uneconomic." Well, I'm going to show you some pictures here in a moment to show you it gets higher than that in some place. So you're going to need to engage in this frenzy of drilling, and that's problematic for a number of reasons. Look, you don't have to be an enviro, you don't have to be a tree hugger to understand that if you're going to go in and drill 7,000 wells per annum just to keep production flat, and you're going to go into a lot of areas in the Northeast that are going to be heavily, densely populated, you can't engage in heavy industrial activities on that kind of scale without environmental degradation, health impact costs, road damages, and so forth. You can't do it. And you don't have to be an environmentalist to see that. It just can't be done. So, and at some point, quite frankly, you run out of places to drill. I mean, you just do. So that is the problem with shales, is they decline much too quickly. The wells deplete much too quickly. And you can't keep that production ratcheted up. We know that shale gas production has already peaked in December of 2011 in the United States. And based on actual production history, unless they engage in this serious frenzy of drilling, which they are not equipped to do at this point in time, all shale plays will be at stripper well status, or basically done in about 10 more years, by 2024. And that's oil and gas. So, you can see why this is a problem. We cannot afford shale. Shale can be a part of the overall energy mix, and it should be a part of the overall energy mix as we transition to renewables, but it should not, we should not be complacent and put all our eggs in the shale gas basket, because it's simply not performing up to industry expectations. Somebody said they wish they'd done Cracknomics. I wish that I had coined that term too, but it actually came from the Financial Times in London, and but I love it. I think it's so great. So here's what we know. We know that economic benefits are short-lived in every play thus far, and I'm going to show you how that breaks down by a county basis.